Hello and welcome. Today we're going to address an issue that's top of mind to a lot of Treasury Strategies clients. Today we're going to discuss the impact of the new money market fund regulations on corporate investment policies. As you know, the SEC in the United States recently initiated some changes to Rule 2A7 regarding money market funds and how they operate. And unfortunately, there's been a lot of hyperbole and misinformation in the marketplace about what these rules actually mean for corporate treasurers and their banks and other financial institutions in terms of the actual operation of money market mutual funds. Today, we're going to set the record straight on this and give you an action plan for moving forward with your investment policies. Now, as you know, Treasury Strategies consults with corporate treasurers on all issues Treasury, including investment policies. We see a lot of investment policies that our clients from around the world are using, and we work with corporate treasurers in actually developing and revising investment policies. So now let's take a look at the actual regs that were passed in the U.S. And as I mentioned, the U.S. has enacted regulations scheduled to go into effect in October of 2016. The European Union is considering a set of regulations on its own that are directionally similar but in some ways different from the U.S. regulations. These haven't been finalized and are still in a state of flux, so we're going to focus for the time being on U.S. money fund regulations, but it's entirely likely that the advice we have, at least with respect to investment policies, may carry over. Let's begin with an overview of the regulation that's going to go into effect in October of 2016. And there are 4 key points here. The first part of the regulation requires institutional prime and municipal funds to move to a fluctuating net asset value. What that means very simply is money funds used to trade at $1 per share, 1.00. And because of the accounting methodology that funds could use, they stayed at 1.00, which obviously made the accounting and everything very easy. Under a fluctuating NAV, or sometimes called variable net asset value, or VNAV, or FNAV, depending on who you read, there are a lot of names here, but the value will now be carried out to 4 decimal places. So instead of 1.00, it's 10000. And because of the daily fluctuations in security prices in the marketplace, it's entirely possible that someday you can go down to 9999 or 9996 or up to 10003 or whatever. These are minuscule changes, but they are in fact changes which you need to deal with. Second part of the regulation provides additional tools to fund boards to manage their funds in a liquidity crisis, and they allow for the possibility in certain circumstances for the fund board to implement liquidity fees for redemptions or exit gates that actually prohibit investors from withdrawing their funds for a period of time. And today we're going to be focusing on these 2 specifically because I think this is where we see from our clients that the greatest amount of misinformation exists in the marketplace. Point 3 is enhanced disclosures and stronger portfolio management requirements. These obviously accrue to the benefit of fund shareholders. And then 4th point, as I mentioned earlier, the impact is primarily on institutional prime and institutional municipal funds. These, along with institutional treasury funds and government funds, are what are most commonly used by corporate treasurers in your day-to-day liquidity management. So next, let's take a look at how Treasury Strategies interprets these new final regulations as promulgated by the Securities and Exchange Commission. As most of you know, Treasury Strategies fought vigorously through this long process of rulemaking. We submitted a number of white papers, which, by the way, are available on our website, We testified several times in front of the United States Congress on the issue. That testimony is also available on our website. We did not believe that these regulations were necessary, nor did we believe that they would go very far toward achieving the objectives set out by the SEC. However, the SEC voted to implement regulations, and the headlines of those regulations sound very onerous, as they did throughout the rulemaking process. However, when we look at the final regulations and read the fine print, they actually address many of the concerns that we raised through the consultation process. For example, on the very same day that the SEC proposed the rules, in a coordinated announcement, the U.S. Treasury and the IRS issued guidance about safekeeping and record keeping for money market funds that actually goes a long way toward reducing the record keeping burden on corporate treasurers. The proposal, which the accounting standards boards are currently reviewing, and there appears to be no objection, is that corporate treasurers will be able to rely on the record-keeping services of their fund companies and make periodic, not daily, but periodic journal entries to reflect the net gains or losses if there are any. I think this is a recognition on the part of the regulators and the accounting bodies that these gains and losses from a fluctuating NAV are in fact de minimis and not really worthy of daily in and out accounting. The second is relief from the wash-sale rule, which is a rule regarding the taxation of capital gains and losses that result from frequent purchases and sales of the same security. This relief is also very important and goes hand in hand with the record keeping. One of the ways that money funds were able to maintain the constant net asset value of $1 a share was by using the amortized cost method of accounting, which means that when you buy a security, like a money market instrument at a discount, you simply straight line its appreciation through the maturity date, so there's a specific amount of income and appreciation every single day that that security is owned, and as a result, in effect, you have a constant net asset value. What the SEC has done is preserved amortized cost accounting for all securities in a fund portfolio that mature in 60 days or less, which goes a long way toward minimizing the degree or the amplitude of the fluctuation that you might have in a net asset value. And in fact, several fund companies are already speaking about instituting 60-day maturity money market funds, which in fact will be able to use amortized cost for their entire portfolio. And while the SEC will not permit them, those fund companies, to advertise that they have a constant $1 net asset value, for all practical purposes, that would be the net effect. And the final point is that the enhanced tools require that fund boards act in the best interest of the fund shareholders. I think all this is pretty good. So what does all of this mean for your investment policies? Let's take a look. As you can see on this slide, Treasury Strategies sees a lot of investment policies in our consulting, and we work with a number of clients, and for the most part, the policies we see are fairly broadly written. They're really objective statements rather than detailed prescriptions. Buy 2 of these, sell 1 of those, and divide by 4, and that's your answer, sort of thing. They're not nearly that prescriptive. So we recently took a sample of 20 investment policies by 20 of our clients who are, for the most part, large global corporates. And when we studied these carefully in light of the new SEC regulations, we found that 18 were actually broad enough that the policies could continue as written with no change required. 2 of the 20 that we examined needed change. So we're going to jump into this and look at a couple of things in the objectives of the policies. One of the things that most policies have is an objective of preservation of principal. And I'm sure your policies say something along those lines. Now, that does not necessarily rule out VNAV or FNAV or fluctuating net asset value funds. And in fact, every instrument in the money market that you do not hold to maturity does have risk of principal. Market prices of commercial paper and market prices of treasuries fluctuate every single day. And if you don't hold them to maturity, you will have the same de minimis gains and losses as you would in a variable net asset value money fund. I mean, functionally, these are equivalent in terms of their daily fluctuations if you're not holding them to maturity. So preservation of principal does not, in our mind, and the clients that we work with, rule out a VNAV fund. Now, a second objective that most funds have, that most investment policies have, is the objective of maintaining daily liquidity. And again, this does not rule out funds that are subject to fees and gates. Most of the policies we see say that the portfolio manager must maintain liquidity to meet the daily needs of the firm. That it does not say that every instrument in the portfolio has to be 100% liquid every single day. And in fact, those of you who are close to the investment world realize what a silly policy that would be if every instrument in your portfolio had to be 100% liquid every day. The fee part of the fees and gates gives the board an option to assess a fee under very certain circumstances for redemptions from the fund. We would point out that this is analogous to an early withdrawal penalty from a bank deposit. You know, if you need the money or if you have concern about your counterparty risk and you want your money out of a bank CD, you break that CD, you pay a fee, and you get out. Similarly, if you really want to get out of a money fund and you want to get out now, you pay the liquidity fee if one is being assessed, and you get out. Each, by the way, can be avoided by continuing to hold the instrument. Now, you may not like the counterparty risk and want to get out, but the two work in exactly the same way. So, if you hear arguments and some of the hyperbole, which is why we can't invest in anything that could possibly assess a fee, well, that kind of means you can't invest in bank deposits either, which of course is ridiculous. Gates, in our mind, are analogous to bank holidays or withdrawal suspensions. These are extremely rare. You may have heard the term suspension of convertibility, which means a bank can suspend the convertibility of your deposit into cash. I mean, this hasn't happened except in the case of bank failures in like decades, but it is in the statute just as gates are in the statute. So in many ways, that's analogous. I do want to point out, many of our clients say, well, gee, Tony, that's kind of interesting, but my deposits are FDIC insured, and therefore I'll get my money even in the event of a bank failure. And we want to point out that while this hasn't been tested because the too big to fail mentality has bailed out all the banks in trouble, but probably not the next one. The policymakers are looking to say that too big to fail is history. But the FDIC regulations stipulate only that in event of a bank failure, the FDIC must begin the process of resolving that failure within 48 hours. In other words, the bank can fail, and the FDIC has 2 days to start thinking about what to do, and no limit to how long this could take, be it days, weeks, months, or even years to resolve. That doesn't sound like daily liquidity. Now, a macroeconomic way to look at this is to see that these SEC regulations that are imposed on institutional prime and municipal money market funds simply codify what the way the market already treats other money market instruments. As we mentioned, all other money market instruments float every day. Your commercial paper, your Treasury securities actually fluctuate in value every day. You don't notice it because mostly you're holding them to maturity, but they do fluctuate every day. And all this does is puts money funds back down a notch on par with commercial paper and Treasuries. The fees, as we mentioned, for exiting a fund or a bank deposit, frankly, that's pretty much analogous to a market-imposed haircut on a distressed sale of a security. If a lot of investors are trying to sell, XYZ, Mercury Finance commercial paper, all on the same day, there's a haircut. What the SEC regs do is simply codify what the market already does for other securities. In terms of gates, I was recently speaking at a conference, and I asked for a show of hands of how many attendees had invested in auction rate securities in 2008, and several hands went up. And I asked, then keep your hands up if you still are holding them. And many of the hands stayed up, to which I chuckled, so how's that 7-year gate working out for you? The market already imposes these disciplines, and what these regulations do is simply put money funds that were previously in a preferred position back down to actually a market grounded position. So what I've talked about so far are money market funds. Many of you have heard about new products or services that investment advisors may soon be issuing. So let's take a look at some possible new products. We've heard that some asset managers will be issuing 2a7-like funds. 2a7, by the way, is sort of the regulatory nickname for money market funds. So these would be funds not registered with the SEC, but operate like the old 2a7 rule. Obviously, there are separately managed accounts that could be structured in different ways. We expect to see new flavors of ultra-short bond funds, and there's certainly a lot of conversation in the marketplace about private funds or collective trust or arrangements like that. It's highly likely that some of these new products are so new that they weren't envisioned when your investment policy statement was written and may actually fall outside of your current guidelines. If that's the case, you will need to update your investment policies and revise them to incorporate these kinds of products. And the best way to do that, frankly, is to have conversations with your asset manager, and I'd say it's 99.9% likely that any asset manager coming out with one of these new products can give you the precise paragraph that you need to drop into your investment policy in order to have it be approved. So, as we put this all together, what's the bottom line? And our conclusion is really, it's not clear how many policies need to be changed. On the next slide, many of the policies, as they're currently written, may well be just fine and suited for your needs. However, we strongly recommend, whether you need to change the policy or not, to certainly keep the lines of communication open and keep the dialogue going. And you need to have a conversation with your CFO or with your board's investment committee to inform them of the changes in the money market fund regulations or the possible new products, and to help them understand the functional equivalence between the new 2a7 money fund regulations and all the other existing instruments in the money market, and understand that what these regulations do is essentially take away a preferred position that money funds enjoyed and put them back more toward a parity with other money market instruments. So a recommendation to you would be to first, stay abreast and understand what's going on with the regulations, and of course we can help you with that and attend our corporate cash briefing webinars. Understand the regs, and then explain and show how the money market funds are still functionally equivalent to other money market instruments. And the fees and gates are no more onerous than breaking a bank CD or getting caught up in an FDIC bank failure or whatever. These are going to be extremely rare events, and to have a tail wagging the dog is probably not the best way to run your investments, particularly since fee and gate equivalents exist in other money market instruments and bank deposits. And then finally, keep the CFO and the investment committee informed as we move toward the October 2016 implementation date. And also, for those of you doing business in Europe, stay tuned, and Treasury Strategies will keep you abreast of how those regulations are working out. And then finally, call us. Call us at Treasury Strategies. We would like to work with you as you work through your investment policies, as you work through your strategies in a post-regulatory environment, and frankly, as you enhance any aspect of your Treasury operations. We're the experts. Our consultants are available to help and to bring us all to a successful outcome. So thank you for listening, and we look forward to hearing from you.